Hey everyone, and welcome back. In today's video, we're going to be discussing why I'm personally waiting for the next stock market crash before making any significant investments. So no, I'm not 100% in cash. If I was 100% in cash and I was running a stock market channel, that would be pretty ridiculous and pretty absurd. So no, that's not the situation, but I am sitting on about 50% in cash. So I'm going to discuss why I'm sitting in 50% cash, and I just want to talk about some of the broader market trends that I'm seeing in terms of valuations, and that'll help explain why I'm not investing a lot more of my money in the market. And we'll also talk about what I'm seeing on the individual stock level in terms of valuations. And then towards the end, I just want to talk about how you can decide how exposed you want to be to the market, because how much percentage of stocks you have and percentage of cash, it all just comes down to how exposed to the risks of the market you want to be. And I have a couple of pointers that can help you make that decision rationally of what percentage of cash you should have right now and what percentage of stocks you should have right now. So that's what we've got to look forward in today's video. If you do enjoy it, I would really appreciate it if you hit the like button, because that helps me out more than you would know. YouTube loves likes, and actually if you share it with a friend, that's the best thing that you can do. YouTube loves shares and loves external traffic. So if you want to really support the channel for free, then go ahead and share it with a friend. But for now, let's just jump straight into the video and start by talking about some of the broader market trends that I'm seeing, and talk about some of the statistics that may suggest to us that it's better to wait with a significant amount of cash on the sidelines. So in terms of the broader market, I would personally say that it's quite obvious that the market is overvalued. If we look at something like the Shiller PE, so the Shiller PE, it takes a 10-year average of the last 10 years of earnings, it takes an average and compares it to the current price of the S&P 500. So we're looking at the price compared to the average cycle earnings from companies in the S&P 500. And if you look at that over the past 10 years, 10 years ago, you were able to pay about 15 times earnings for the entire S&P 500. Now, fast forward to today, the Shiller PE is at 30. So valuations have doubled in that time, even while earnings have grown. So earnings have grown and stock prices grew with it, but stock prices grew twice as fast as earnings in this period, and you are paying twice as much than you could have paid 10 years ago for the exact same stocks relative to their earnings. Now, looking at that graph, you can see that there's been a pretty consistent upward trend in the Shiller PE since about 1980. And the reason why this has occurred is likely in part due to the interest rates in the US being consistently going down since 1980. And these two generally work inversely, because when interest rates are lower, interest rates going down since 1980, slowly, the risk-free alternative that we can invest in, which is US bonds, the return that we can get on those bonds goes down with interest rates. So what that means is that as that return goes down for risk-free assets, people are willing to pay a little bit more for risky assets, such as businesses. And the result of that is that multiples, PE multiples, the price that you're paying compared to the earnings of the businesses on the S&P 500, has been consistently getting more expensive since 1980. And now we're in a situation where interest rates are at rock bottom, which means that the US Federal Reserve can no longer use their lowering interest rates in order to spark the economy and to spark the stock market. So what that means is that if earnings of US or Australian companies, for that matter, drop, we should expect to see stock prices drop considerably with them. And even if earnings for these companies does not drop and earnings continue to expand over the next few years, we shouldn't expect that prices are going to grow at the same rate or higher as they have in the past. So in the past, we've had growing earnings as well as interest rates coming down, which means that that's two levers pushing upward on stock prices. Now we're looking at maybe earnings will go up or down over the next few years. We really don't know. But even if they do go up, they're not going to be going up in combination with interest rates going down. They're going to be going up in combination with flat interest rates or even interest rates going up, which means that there's going to be a lot of downward pressure on stocks. And the result of that should be a broad market sell-off in the near term, in the next couple of years. Another thing you need to think about is that we've had very low inflation for quite some time. And that means that the Federal Reserve or the Reserve Bank of Australia has not had to increase their interest rates to curb that inflation. So all the way back in the 80s, there was a huge amount of inflation. And the result was that a lot of central banks, such as the US Reserve Bank or the RBA in Australia, had to hike their interest rates into the double digits in order to reduce spending, in order to reduce that inflation. And recently we've had very low inflation, but inflation could pick up again, especially with the developments in tech that we're seeing. A lot of these technologies are making things very cheap, which means consumers can spend their money elsewhere, and that spending is going to increase prices. And if we do see that inflation, interest rates are going to go up, and the reverse of what has happened since the 80s will occur. And that is that stock prices will come down because risk-free assets such as government bonds from Australia or the US will look better compared to stocks, and some people will be less inclined to take risk in businesses, and they'll move more of their money into bonds. So on a broad market scale, I would not expect to make a higher return just from tracking the market over the next few years. I would think that it's going to probably be significantly negative over the next 5 years, if not somewhere flat, because earnings could continue to grow, but then that valuation could come down, which means that stock prices really don't move for a few years. That's another alternative. So broadly speaking, the opportunities in the stock market in the short term, in the next few years, really doesn't look that good. And on an individual level too, I'm seeing a very similar thing. So obviously, I don't value every business in the S&P 500. I'm not capable of that. I don't think anybody is capable of doing that. But I do have a short list of maybe 8 to 12 businesses that I thoroughly understand in industries that I understand, and I've put a value on them, and I've been calculating their values consistently since I've been investing. And also many of the members in my private platform would know that many of the stocks that I'm analyzing in those platforms are some of the stocks that I'm looking on my watch list as well, and these businesses are overvalued, or at least they're at fair value. So most of them are significantly overvalued. Some of them are hovering around fair value, but they're usually the more defensive business models. But certainly businesses that have growth potential in them, they're significantly overvalued. And this tells me that there should be a time in the near future when the valuations aren't so ridiculously high. I mean, at the moment, for most businesses, I'm seeing that it's probably possible to get somewhere between a 6 and 10% return on some of these businesses safely over the next 10 years. But for me personally, that's just not enough. And I'm looking for a significantly higher return, which means that I'm waiting for these stocks to fall, 30 to 50% before I go ahead and invest some money, so that I can guarantee that I'm going to make that 12 to 15 to 20% return on each of those businesses. So if many of the businesses that I'm analyzing and that I'm going to be potentially investing in over the long term are overvalued, then you might ask, well, why don't you sit 100% in cash? And I've got a very valid answer to that. And the reason is that businesses will always outperform cash over the long term. Businesses will always outperform cash. So you always want to have a significant amount of your wealth invested in businesses, in public businesses, in stocks. Even if those stocks are only returning 6 to 10%, that's significantly better than what you're getting with your cash, which is probably breaking even once you take into account inflation. You might get 2 or 3% on a term deposit or a bond with your cash, but then inflation of 1 to 2 to 3% is going to eat that away, meaning that you really don't make anything on your cash. So if you hold businesses that earn 6 to 10%, they're massively outperforming the cash. But of course, you then don't want to be 100% in cash, because you want to keep some on the sideline for opportunities that occur when there is an economic downturn. You certainly don't want to be caught 100% in businesses when stocks fall 50%, because that means you have no cash available for you to take advantage of cheap assets. And that's essentially what I'm doing right now. So I have about 50% of my money in businesses that at the current prices might earn somewhere between 6 and 10%, 6 to 15% hopefully, but it depends on how they perform over the long term. And then I'm holding 50% of my money in cash, partly for my business and partly because I'm waiting for an economic downturn where some of these stocks will come down 30 to 50%, and that means I can invest it cheaper. And if there is an economic downturn, then I would likely have a significant amount more of my money invested in the market. But at the current levels, broadly speaking, and what I'm seeing on an individual level, it is indicating to me that in the short term, meaning in the next 3, 4, 5 years, we should see an opportunity where we're going to be able to buy assets, buy stocks at a cheaper valuation. And I'm willing to have a significant amount of cash on the sideline waiting for that, especially since I've got such a long horizon to invest over my lifetime. So how exposed should you be to the markets? How much cash should you be holding and how much stocks should you be holding? And I can't answer this question for you, obviously, because you have your unique circumstances in your unique situations. But I can talk about some of the factors that influence my allocation between cash and stocks. And there's a bunch of different factors. There's obviously more than this, but there's really two major ones that I've noticed. The first one is what kind of return you're trying to achieve. And the second one is what is your time horizon? How long are you going to be investing for? So let's talk about the first one, which is what kind of return that you're trying to aim for. So if you're just trying to aim for a market average return, if you just want to get 6 to 10%, then there are a couple of options. One, you could invest in index funds and just accept the market return. And the other option is that there's plenty of businesses, great businesses at the moment, that are offering between 6 and 10%, even at the current levels. Now, that doesn't mean that they're not going to fall when there's a recession. They're still going to fall. But even through that fall and coming back up, businesses at the current price, comparing that to how much cash we can get out of them, it looks as though we can probably safely get between 6 and 10% on some businesses. So if that's what you're aiming for, then by all means put more of your money into the market, because if you're happy to get that and you can forego some of those bigger returns, then just put more of your cash to work in those businesses that are great businesses so that we know we're going to get that return over the long term. Now, I did just mention index funds, but if you're going to be index fund investing, you really shouldn't be looking at a 10-year horizon, because I think when it comes to index funds, the only way that they make sense is if you're investing over the very, very long term. So I'm talking 30 years or more, maybe a very, very long time. Now, you could have patches of 10 years where index funds do very well. Over the past 10 years has been a great example for the US market, especially. But that average of 8 to 10%, it really bothers me when people say, oh, I'm just going to index invest and get 8% guaranteed. That 8% is not guaranteed. It depends when you start investing. And of course, the longer that you invest in an index fund, the closer your return is going to be to 8%. But in terms of right now, you really shouldn't make the argument that, oh, I'm not going to invest in individual stocks because they're too risky. I'm just going to buy the index and get 8%. That's not how it works. Personally, I think that index funds will probably return either negative returns over the next 5 or 10 years or zero returns over the next 5 or 10 years. I think that's very possible considering the current valuations. And remember, when you're buying an index fund, you're just buying everything expensive. You're not avoiding expensive stocks. You're buying everything expensive. So you've got to realize when the broader market is expensive, relatively speaking to other times in history, then the return is going to be lower than the average over that time. So the average market valuation over 100 years is generally around 15 times earnings, right? So if you were to buy the index at 15 times earnings, your return over the very long term, 10, 20, 30 years, would be much closer to 8% than if you started investing now in an index fund. Because if you invest in an index fund now when it's 30 times, then you shouldn't expect that you're going to be able to get that average return. You might have a little bit of a lower average. So that's just something I wanted to mention, because don't assume that just because you invest in an index, you're guaranteed to make 8% or something like that. Be aware that you could go through periods where you earn significantly less, and that it actually could be beneficial to be more in cash and to take control of your investments and actually invest in individual businesses. But the final thing I wanted to talk about was the other factor, which is your time horizon. So depending on your time horizon, you would want to be more defensive or more aggressive. If you need your money in the next 10 or 15 years, I would say maybe 10 years, if you needed your money in the next 10 years because of retirement or you're buying a house or some other reason, then you should not have significant amounts of money in the market. You should be much more defensive than someone who can go through 10 years of not being able to touch their money. And the reason for that, I've explained it pretty well over the past video, I think, over this video, I think, but essentially valuations are really high, so we shouldn't expect that returns for the next 10 years will be great. on a broad market level. And especially when you're investing in individual stocks at these levels, most prices, at least from the stocks that I've been looking at, which are still value investments, but they're really just not offering returns that are substantially high. And many stocks will go through and not be higher than they are now over the next 5 years. So if you have a short time horizon, you should be much more defensive, broadly speaking. And if you have a much longer time horizon, then you can be a little bit more aggressive because you can weather and go through those troughs and you don't need to worry about it because you can just invest more consistently through that time and over the very long term. As long as those underlying businesses are great, you will make a decent return. So just to summarize, I really make my asset allocation decision. I really make my decision to have stocks or cash or what percentage of each mostly based off the individual valuations. So I'll look to each business, I'll look at what return they're offering me, and if it's above 15% safely with a 50% margin of safety, then I'm going to be wanting to invest a significant amount of money there. Right? But at the current time, I'm really not seeing that. There's maybe one stock in my portfolio which I think offers that pretty convincingly, but the others, not really. Maybe convincingly they'll offer an 8 or 10% return, but that means that I'm not ready to commit 70, 80% of my wealth into the stock market. And for that reason, I hold a little bit more cash and I'm waiting for those opportunities. And the broader market trends, such as the Schiller PE, help me to make that decision too, because the market is clearly overvalued in terms of past history. And that means that we're likely going to see a correction in the near term, or at least we're going to see cheaper valuations sometime in the near future, or we would hope that we would. And for that reason, I'm willing to take a little bit of a more defensive position and have a little bit more cash and keep that available for those opportunities. So I hope you guys enjoyed this video. And as I said earlier, if you did, I would appreciate it if you leave a like, share it, leave a comment, just do something that interacts with this video, and that's what YouTube will like to see. So I appreciate everyone who does that. And if you have any kind of topics you want me to discuss, this was a topic from one of the viewers who wanted me to discuss this, so I thought I would put it together. If you have a topic that you want me to discuss, then make sure you leave it down there in the comment section below. But for now, guys, I'll see you in the next video.